Hi again everyone, hope you're all doing really well. So finally there has been a bit of a glimmer of hope for Exela Technologies the other day. On Wednesday, while the broader markets jumped on the sense of news that an interest rate rise may not be coming this month but more likely in March, Exela Technologies had a bit of news of its own. That being that they are undertaking a share buyback of sorts via the optional bundling of 25 Exela shares into a tradable $25 par value note with an annual 6% interest or coupon payment. Xela traded as high as 35% up during that session on this news, before settling to finish Wednesday's session a strong 16% on the previous day's close. The stock on Thursday did dip again following the hawkish outlook from the Fed, before moderating during Friday's session. So in this video, I want to take a bit of a look at the announcement and how much the tradable note is actually worth at the moment, and give my thoughts on what I think it means for Exela Technologies going forward. So this is more of a focus on the note and not so much a look at recent trading or technical information. So let's get into it. So here are the main points of the announcement from Exela Technologies. That being that shareholders can exchange blocks of 25 shares of common stock into a tradable $25 note, which is due for maturing in 2029 with a 6% annual interest rate. At the time of the announcement, this offering was an 82% premium on the closing share price of January 25th, which was 55 cents. However, we do know that the current Xela share price is now 63 cents, so that 82% premium is a bit lower. Like any buyback, shares committed to a buyback, or tendered in this case, will be retired, and the company is expecting to reduce the total share float by 29%. However, if 100 million shares are prescribed to, this figure could be closer to 50% of shares. And if you are thinking of undertaking this buyback, the participating shareholders need to instruct their brokers by the 24th of February, and they advise to give plenty of notice. So what does it all mean? What are you getting for the note? Well, based on Friday's 63 cent closing price, if you held the note for its entire life at an undiscounted total, you would receive a 37 cent premium on the face value, as your 63 cents is basically being exchanged for $1. And then in terms of coupons, you're getting 6%, so which is 6 cents on $1, and times that by 7 is 42 cents. Of course, this is all undiscounted. Anyway, for every Xela share committed to the deal in bundles of 25, of course, you will receive a total undiscounted 79 cent premium over the course of 7 years. Now, per a note, because there's 25 shares make up a note, the note is going to cost you basically $15.75 worth of stock as of the close of Friday price, which is 25 times 63 cents. Okay, at maturity, the coupons and the par value of the note, you will obviously get your $25 face value for the note, plus your coupons, which are paid 7 times, and that is worked out at 6% of $25. So total is you're going to get $35.50 in this time. Basically, that $35.50 represents an undiscounted $19.75 if held to maturity. Now, I talked about being undiscounted. When looking at prescribing to this type of deal, it is important to understand the time value of money. Basically, the idea that $1 today is worth more than $1 in a year's time, or in the case of this, 7 years' time. As a result, when calculating the cash flows that will be received from a note or a bond, it is important to apply a discount rate. Currently, the market long-term discount rate is 1.92%, which is understandable as interest rates are quite low, and despite a few rises set to be on the horizon, are expected to remain historically quite low, at least in the current outlook. The purpose of the discount rate is to give investors a target that they should be aiming to beat with their investments, and typically symbolizes what could be earned by leaving an investment in the bank for that period of time and earning interest. This is because typically a bank is seen as a safe place to store money and a pretty safe investment. So we will use a 1.92% discount rate to calculate the discounted cash flows that investors will receive if they convert their Xela stock into $25 notes by February, or in other words, what the actual value of the deal is for someone who takes up this deal. So to start with, we need to work out the principal or par value that the note will receive at maturity in 7 years, and divide it by its interest rate to the power of 7. So we take the $25 par value, divided it by 1.92% to the power of 7, because it's over 7 years, And that means that $25 is actually worth $21.88 in present day value. We also need to take this same approach to all of the coupons or interest payments that these notes will garner. This is a little more time consuming to do, as you have to adjust the calculation for each cash flow, as there is a different time horizon for each one. Basically, you're getting one every year. So what was initially thought to be $10.50 in present day dollars ends up being more like $9.75 once you factor it in. So that's the first year, so that would be to the power of 1, which didn't do anything. Power of 2, 3, 4, 5, 6, 7, and we get simplified down to this sum here, and that equals $9.75. To finish off with, by committing $15.75 today over 7 years, investors in these notes will receive back $31.63 in adjusted earnings, or a premium of $15.88. So basically, an investor would end up doubling their money over the course of 7 years. So I suppose when making a decision on whether to take up this note conversion, you need to think, would you be able to double your money in 7 years' time or not through another investment? If not, this could be the investment for you. Now, beyond understanding the time value for money with this note deal, there are a variety of other risk factors that need to be considered. First and foremost, these notes that Xela are issuing are unsecured. That means if Xela was to tank as a company, there are no assets backing the notes and they can basically go to zero. This happened in my native Australia at the start of the pandemic, when the airline Virgin Australia had $100 notes with a 7% interest rate, and Virgin went under, and those notes basically got wiped out. So people who bought those notes lost their money. So it can happen. So you have to ask yourself, is Xela going to be around in 7 years' time? My gut feeling says yes, but with all these things, you never really know. Again, while we talked about the numbers of how much the holder of these notes will get, this generous premium won't be fully realized until 7 years' time, which isn't terrible, but still, it's not that you're doubling your money overnight by doing this. You have to think about, can you hold on to the investment for this long? Do you want to hold on to the investment in this long? The good thing about it being a tradable note is that you can sell it at any time as long as someone wants to buy it. The next factor to consider is interest rates are going to be on the rise, meaning over time, a higher long-term discount rate will likely need to be applied when calculating the value of the note. This means the adjusted earnings for the note will at least dip during an interest rate rise. If interest rates do eventually come down again, that would actually put the value of the note up. And finally, as was highlighted at the start, the notes need to be prescribed to before February 24. Now, this can be challenging because if you want to properly understand Xela's books and how this is going to affect the underlying share price, we won't really know much more about what Xela is shaping up to look like until March, when they release their Q4 results. So the fact that you have to prescribe to this before those results comes in makes investors just that little bit more murkier in their vision for how the company is going. Now, of course, there is an alternative. You do not have to convert your shares to notes. The alternative investors have is to keep their Xela shares. Theoretically, what this means is that there should be a bit of a boost in the share price. If fully prescribed to, it will leave Xela with a float of 73 million shares. This means the company's assets will be divided amongst less shares. However, so will their liabilities, which would now include an extra annual interest obligation of $6 million, as well as a long-term liability of $100 million for when these notes mature. Although, in saying that, it would seem that Xela is expecting to only reduce their share float by 29%, which means they're only expecting about 50 million shares to be committed to this share buyback. Even still, this would theoretically provide a boost to the share price if one was to hold on to the stock. How much higher it goes is hard to say. To be honest, we probably won't be able to properly analyze this until the Q4 results come out in March, and perhaps not even fully comprehend the financial effects until the following set of results for Q1 in 2022, which are not set to be released until June. Like I said before, basically leaving investors a little bit blind on this one. These future financial results will allow us to see not just the shape of the company in terms of earnings, but also update us on the levels of debt and how much this note conversion activity is prescribed to. Moving on from the financials of Xela, we also have to keep in mind that the current poor market sentiment surrounding basically everything, this will likely continue to weigh on the Xela stock price despite any material improvement this event has on operations and overall shareholder value. So moving on to some final thoughts, Xela has obviously got the company into a position where they think they can afford to undertake an on-paper share buyback. I do wonder how much this will change their balance sheets, which have apparently been cleaned right up through their recent deal with B. Riley Capital. However, this means that there will now be a big amount of debt put back on their books. Perhaps they're a company that loves a bit of debt. This deal gives dispirited shareholders a chance to exchange shares for what at least appears to be a decent premium, or if they don't, will at least mathematically increase the underlying value of the stocks that they hold on to. However, the value of such things still needs to be considered within the context of the current environment of rising interest rates and poor market sentiment. Personally, I am still considering what to do. I may convert some of my shares to the new notes and keep some shares in my portfolio as a means of hedging my bets. I'm still undecided, however. Anyway, what are your thoughts on Xela's note offering? How popular do you think the prescription will be? What effects do you expect to see on the share price? Let me know your thoughts in the comments below. Until next time, everyone, may the markets trade in your favour. Cheers.